Welcome to the Sophisticated Investor Series, first lesson of 3 regarding stock fundamentals. In this lesson, we'll cover what a stock is, in the next lesson, why invest in a stock, and in an upcoming lesson, when to invest in stocks to yield the most gain with the least amount of risk. So when a company wants to expand, it typically has 2 available options to raise capital. First, the company could borrow money utilizing 2 approaches. It could borrow from a bank in the form of a loan, or it could borrow from private investors by issuing corporate bonds. Now, we'll talk about corporate bonds in a future lesson. However, this can be very difficult for new companies, as banks do not lend to new companies with no profit or revenue and no security. So if they have no collateral like a building to put up, banks will typically not lend to a new company. If the company was able to borrow from private investors through the issuing of corporate debt, generally the interest rate would be far too high to service the debt. The reason the interest rate would be too high because a credit rating agency such as Standard & Poor's, Moody's or Fitch would assign a low-grade credit rating. So a company with a low-grade credit rating would have their bonds issued as junk bonds, or currently they're referred to as high-yielding corporate bonds. So essentially, new companies are usually not satisfactorily creditworthy, so they are unable to borrow money to expand. The second option is that a company can sell part of its equity to raise money to expand. The company would file a prospectus or registration statement with the appropriate regulatory body. This document would contain information regarding the company's financial statements, any legal problems the company was having, where the money that is raised is going to be used, the company's management, and insider holdings. The company would then sell stock via an investment bank by way of an initial public offering, which is referred to as an IPO. The money raised by the investment bank would be collected and used as initial investor capital. The initial investor capital is used by the company to continue its operations and grow. So the bottom line is that buying a stock provides a share of ownership in a company. So when you become a shareholder, you have claim on the company's profits. If the company was to go bankrupt, you'd have claim on the company's assets, and you do not have any exposure to the company's debts or liabilities. Now let's talk about a small distinction, the initial public offering versus the stock exchange. When a stock is bought in an initial public offering, the transaction actually funds the company's capital raising. Your monetary investment is responsible for the company's operations and the growth going forward. However, when a stock is bought on a stock exchange, it is a commercial transaction where the stock certificate considered the asset is transferred from one person to another. So this transaction here does not fund the company's capital raising. It's a transfer of assets between one party and another party. So as we look ahead to the next lesson, what a stock is a part ownership in a company. In the next lesson, we are going to look at why we would invest in a stock relative to other assets, the one thing that makes a stock unique, and the advantages and disadvantages of this financial instrument. If you have any more questions regarding what a stock is, please feel free to comment below. I'll see you in the next lesson.